A surprisingly weak wages figure takes just a bit of pressure off interest rates. Woolworths says people are trading in, eating more luxury products at home. And a good day on the market for Origin Energy, but a shocker for Domino's. It's Thursday, the 23rd of February, 2023. Welcome to Fear and Greed, Australia's most popular business podcast. I'm Michael Thompson, and good morning, Sean Aylmer.
Good morning, Michael.
Sean, after the show, you have an interview with Paul Duldig, who is the Chief Executive of State Library Victoria. Now, this is a little bit different. This is Australia's oldest and most prestigious public library.
Yes, I talked to Paul about what business can learn from cultural institutions, such as State Library Victoria, and particularly around creativity and how creativity can really push a business forward and how cultural institutions can help out. Little left field, but very, very interesting.
Did you know that State Library Victoria is one of the 5 busiest libraries in the world?
No, really?
Yeah, I have a fantastic stat, and you can use that in your next pub trivia night, just in case it comes up.
I will.
The main story, though, this morning, Sean, annual wages, which are a critical part of the inflation equation, rose by 0.8% for the December quarter and 3.3% last year, below forecasts, including some from the Reserve Bank.
Yes, still, it was higher than any December quarter increase over the past decade, and the annual rate was the highest since 2012. Both the September and June quarter readings were also at decade highs, so clearly there's wage price pressures in the economy. Private sector wage growth is definitely spearheading the increases. The question is how much wage inflation is actually in the economy. Now, the Reserve Bank reckons wage inflation will accelerate to 4.2% by the end of this year. That would be the fastest pace since records began back in 1997. We're not seeing that yet. Now, wages are critical to inflation because people with more cash in their pocket tend to spend it, which of course pushes up prices.
So overall, and in the interest rate puzzle, the wages reading is good news.
Well, yes, because it suggests that there's less risk of a wage price spiral. I mean, if the figures were much higher than that, we'd all be very concerned about how the Reserve Bank would view that. But, Michael, there is anecdotal evidence around the place, including through the Reserve Bank's own liaison work, that wages are rising faster. Now, yesterday, the Financial Review held a workforce summit. There were a bunch of corporates there. Many of them spoke about a big jump in wages, somewhere between 4 and 8%. But they also said there's a sense that people aren't shifting jobs as much as they have been in recent years. So the wage pressures are there, but people are probably a little bit more worried about job security. So that's a very mixed message. Bottom line, the Reserve Bank is likely to keep lifting interest rates over the next couple of months.
Sean, just while we're on the topic of interest rates, we received an interesting message yesterday from a listener via Instagram. And I really like this when people do kind of put questions really to you. I don't think it's directed necessarily at me. Phil says, "Hi guys, love the show. I'm just a plumber, definitely not an intellect. Don't know about that. I've been thinking a lot about the current economic situation and was wondering why the only tool to fix inflation is lifting interest rates. Would lifting the super contribution do the same thing? I'd much rather put money into my super than give it to the banks."
Well, it's a good question. I mean, the basis of that, is it all about monetary policy or interest rates to keep a lid on inflation? That is definitely the bluntest tool at the disposal of regulators and government. But there's lots of other things they can do. The budget, the federal budget is a really big one. Now, we've heard both Philip Lowe and the head of Treasury, Stephen Kennedy, last week saying that fiscal policy, that's the budget, is relatively neutral, not really putting pressure on inflation or not on inflation. Certainly the government, by taking money out of people's pockets, can slow the economy and have an impact on inflation. So they're the main two parts, monetary and fiscal policy. There's also things like wages policy. So you can make rules around wages to stop the wage price spiral that we were just talking about. In terms of superannuation, what you will find, I mean, putting more money into super might be a good idea and might take it out of the economy, so that can slow the economy. So maybe that does help. What it does do is they give a tax deduction or a tax credit. As a result, that might actually hurt the long-term outlook for the economy. So it's not a simple answer that just to put more money in super. Bottom line to that, Phil, basically monetary policy, fiscal policy, wages policy, government policy, all sorts of things can impact inflation.
It's a good question.
Very good question and a very long-winded answer. I apologise.
I think the only person whose job is at risk here, Sean, is probably mine, because if Phil keeps this up, he's asking better questions than I do. How did local markets respond yesterday?
Well, the S&P ASX 200 finished the day down just a bit, 0.3% to 7,315 points. Very, very busy day for earnings. Now, the banks were mixed. Commonwealth Bank was off 2.3%, but ANZ was up 1.3%. Quite unusual to see the banks not moving in sync. Origin Energy was the biggest gainer, more on that shortly, while A2 Milk Company also did well. Domino's was the worst, plenty on that in a moment, while News Corp was down nearly 9% after saying it won't be selling its US digital real estate business. There were some big moves after company announcements. Gold Diggers and Barbara's share price fell 11%. EML Payments also fell, down 8% after disappointing investors. And the Star Entertainment Group went into a trading halt yesterday before a board meeting to decide on the casino group's future. There's plenty of speculation that it wants to go out and raise money, about $500 million.
And what's happening in global markets?
Well, a little bit. I mean, the Reserve Bank of New Zealand hiked its official cash rate by another 50 basis points yesterday. Rates are now at their highest level in New Zealand since January 2009. Hong Kong released its annual budget yesterday. What I thought was really interesting about that, all these plans to spend up big to encourage people to go and visit the city, to encourage investment. It was a very, very business-friendly budget. And before we leave global markets, Michael, oil remains under pressure and the Aussie dollar has fallen back a bit. It's trading around 68.4 US cents.
All right, there's a bit happening. We'll be back in a moment with the rest of the day's business news. Sean, it's becoming increasingly clear that the federal government wants to introduce tax changes for superannuation, possibly in the May budget this year.
Yes, it's certainly been the topic of the week in Canberra. Prime Minister Anthony Albanese yesterday said he doesn't plan any major changes in super, but he does want to see the findings of the upcoming review of the superannuation system. Things like banning people from using their super to buy houses is not formally a live option, Albanese said, but he did hint that people with large superannuation balances might face a change to tax rates. Now, earlier in the day, Treasurer Jim Chalmers said not many people have a balance over $3 million, but the superannuation tax breaks are costing the budget a lot of money. Interesting, he mentioned $3 million. Maybe that's the magic number. Prime Minister was speaking at the National Press Club and he covered a range of issues yesterday. He said the AUKUS discussions with the US and UK have focused on industry issues and the federal government is pushing the importance of building locally. He also flagged future defence spending in the May budget. Albanese said the passage of legislation for the safeguard mechanism, which outlines a timetable for big emitters to reduce carbon output, is a national security issue because without it, Australia won't meet its emissions reduction targets. Anyway, the Prime Minister certainly had plenty to say.
Sean, Woolworths has delivered a strong half-year performance with things getting back to normal post-pandemic. But one trend remains, people are eating more at home rather than going out.
Yes, so Woolies Chief Executive Brad Banducci said whereas customers previously were trading down, buying cheaper products, now there's been a bit of a shift and people are looking for affordable luxuries. There's still a bit of trading down, particularly around meat and fresh food. Apparently the Odd Bunch range, one of my personal favourites, the Odd Bunch carrots, they're doing very well. But people are trading up slightly in a value-conscious way, which means buying affordable luxuries at supermarkets rather than eating out as much. Interesting, I thought. His comments came as the supermarket leader announced a 14% jump in net profit for the 6 months to the end of December, thanks to not only stronger supermarket sales, but also a rebound in Big W stores. Now, investors pushed the company's share price up nearly 2% yesterday to $37.35. Shareholders will receive a bigger dividend. One thing to come out of it was the information on food inflation. It continued to rise in the second 6 months of last year. Woolies reported average price growth during the December quarter of 7.7%. Massive. The good news, Banducci said, is that some fresh food prices have stabilised following last year's supply chain and weather-related challenges.
Got a bit of a gripe, Sean. I was in my local supermarket yesterday. Do you know what's in short supply at the moment?
Avocados are expensive.
Apples.
apples.
It's impossible to find an apple. An apple is like a staple of the fresh produce department. And usually there's about 8 different varieties and they range in price from $3.50 a kilo up to about $7 a kilo. There was one tray of like pink ladies or something. And no one really likes pink ladies that much.
Oh, whoa. So much to unpack there. But firstly, very early in the season, Michael, you're from the country, you know. I mean, I grew up in Orange. That's the apple capital of New South Wales.
Let's not get started on the bizarre kind of irony of Orange
being the apple capital. No, we won't. But pink ladies, they're my favourite.
Why?
Oh, they've got so much taste, crisp. They are the best.
Okay. Well, I didn't get the support I was looking for in my campaign just then, but anyway, we'll move on. Sean, Canadian giant Brookfield and US private equity firm EIG has cut its bid for Origin Energy from $9 a share to $8.90. Now, a lower bid price sounds bad, but Origin's share price jumped 13% yesterday to $7.90.
Yes, in terms of a lower bid, it's about as good as it gets since many shareholders expected a significantly lower second bid for Origin, but the bid was about 1% lower. That ain't much. Now, the original bid was considered very generous, a premium of about 55%, a little bit under that. This one's still at about 33% to the prevailing share price ahead of the original offer. That's still pretty decent. Now, the two groups went back to the drawing board after the federal government changed rules around gas pricing late last year and the economics of the industry changed. Market watchers really thought that the takeover, well, it might be derailed. Otherwise, a much lower price might be offered, particularly since due diligence just went on and on. It went for about 3 months. However, the bid yesterday is still pretty good. Now, Origin is all about energy transition. That's not an easy path. And we know Brookfield really wants a platform to build an Australian renewables business. Remember, it bid for AGL last year. So it's obviously interested in doing a deal. Its local boss, Stuart Upson, yesterday said the group's still committed to invest $20 billion by 2030 in Australia's renewable energy capacity storage. The upshot to all that is that Origin's share price jumped 13%, which went to $7.90. As I said, that's still $1 under the offer price. And I dare say it might just shimmy up a little bit over the next few weeks.
Ooh, shimmy. I like the sound of that. Now, Rio Tinto has joined BHP and Fortescue, cutting its dividend after full-year profits fell by 38% to $13.3 billion US.
Yes, it's well and truly less than last year's bumper dividend, though it is actually better than many analysts expected. Iron ore prices have fallen. In fact, iron ore prices for Rio were down on average about 26% over the full year, and that's why we saw the drop in profit. There also were some inflationary pressures and a one-off tax payment that hurt margins. While lower than 2021's record-breaking $21.4 billion profit, last year's profit, $13.3 billion, was still better than 9 of the previous 10 full-year profits. So it's still doing pretty well.
Now, we mentioned this one, Sean, at the top of the show. People just aren't eating pizzas quite like they used to. Cost of living pressures are biting, and that's really hurt the country's largest pizza maker, Domino's.
Yes, Domino's share price fell 24% yesterday, and that's the biggest one-day fall ever after Chief Executive Don May warned that home delivery orders are slowing. The group's profit for the December half was down around 30%, and the fast food company said it will pay a lower dividend. May said the company hadn't quite got it right. Overall sales in the 7 weeks since January 1 were up, but same-store sales, which is more of an apples and apples comparison, Michael, like that, the same-store sales fell 2.2%. Now, they've been running a more-for-more marketing strategy. It just didn't really work as well as expected. The company's also lifted prices, added surcharges to try and combat a jump in raw material costs in food and in energy, but many customers simply ordered on fewer occasions.
Energy giant Santos yesterday outlined a very strong core profit, you like that one, of $3.6 billion for 2022 and announced a big jump in its dividend.
Yes, the group's share price jumped 3.5% to $7.04 following the announcement, which came on the back of soaring commodity prices. Of course, that's thanks to a crunch in supply after Russia invaded Ukraine. Now, remember last week, Michael, we talked about the big 5 global oil and gas companies combined making $200 billion US in the December quarter. This is part of the same story, really. another oil and gas company doing well, just not as big as those top five. Chief Executive Kevin Gallagher, who really has to tread the line between producing carbon-intensive raw materials for energy and the green transition, said demand remains strong both in Australia and internationally. He highlighted the need for Santos to do well, for Australia to have energy security. And we also need companies like Santos as the economy switches from higher emitting fuels.
Sean, Australia's largest ASX-listed tech company, WiseTech Global, announced a 41% jump in profit yesterday. It's the quiet achiever, this company, isn't it?
Yes, I agree. This is the company that tracks parcels and things and is a great Australian success story, arguably better than Atlassian and Canva. The bottom line was built on a big jump in revenue, in part thanks to signing up for new big contracts to provide tracking services. WiseTech's share price jumped 4% yesterday. It's the best performing top 25 company over the past year, and certainly one of the best on the ASX 200. In fact, if you take the coal companies out, they've come off a lot, but they had such a strong year last year. I think it's one of the top 5 performing companies over the past year, WiseTech Global.
It's pretty incredible. Though my favourite part was your description of it as tracking parcels and things. It's quite broad, really, isn't it?
It is.
There's a whole range of things.
That's you'll find in parcel delivery parlance.
It's a technical term, is it?
Yep.
Yeah, sure. Yeah, nice. Well played. Now, finally, Sean, an MBA is no longer an automatic stamp for allowing people to rise in corporate life, according to the University of Sydney's Vice-Chancellor.
Yes, Mark Scott, whose resume is pretty good. It includes a stint running education for the New South Wales government, running the ABC and senior journalism roles, said the decline in the MBA lustre was part of a broader shift towards fewer workers going back to university to study master's degrees. Now, according to the Financial Review, Mr. Scott said people were looking for learning that was more specific than what those degrees have traditionally offered. He said people are increasingly opting for online courses and universities need to update their teaching to be more targeted as well as work more closely with companies.
All right, moving on to international news now, and the big global story is the meeting between top officials from China and Russia.
Yes, now China's top diplomat Wang Yi said relations with Russia were solid as a rock, even as Beijing moves to portray itself as a neutral actor that can somehow broker peace in Ukraine. In a meeting with the Russian Security Council Secretary, Huang said China sought to promote mutually beneficial cooperation in all areas as the two nations defend their national interest. Huang's visit comes almost a year after Russian leader Vladimir Putin ordered a full-scale invasion of Ukraine, and according to Bloomberg, it shows that China has little intention of abandoning its staunch diplomatic partner.
And finally, Sean, this one here is really for our Fear and Greed colleague, Adam Lang, who you'll hear as part of our weekend edition. He's been on about this for some time. The largest ever trial of the 4-day work week has found that most UK companies are not returning to the 5-day standard, and some are in fact ready to make the change permanent.
Yes, so the study involved 61 organisations and about 2,900 workers who voluntarily adopted truncated work weeks from June to December last year.
Great word. Truncated.
Truncated is good, isn't it? Only 3 organisations have decided to stop the experiment, or at least pause the experiment, and 2 are considering even shorter hours. The rest were convinced by revenue gains, drops in turnover, and lower levels of worker burnout that basically, 4 is a new 5 when it comes to work days. And about 1 in 6 employees said no amount of money would convince them to return to 5 days a week.
That's extraordinary. I can't wait for the weekend edition to hear what Adam has to say about this.
I'm taking that as my favourite story for the weekend edition, as a total suck-up to Adam.
All right. Okay. If you haven't listened to the weekend edition before, it is very competitive between Sean and I. And we are looking for the biggest story and the favourite story, and Adam judges, and it is a mess. It is definitely worth listening to. Now, up next is the Fear and Greed Daily interview. Paul Duldig, the Chief Executive of State Library Victoria, Australia's oldest, most prestigious public library, and one of the 5 busiest in the world.
As it turns out, all about how cultural institutions can help business, particularly around creativity.
Yeah, it's up next in the Fear and Greed playlist on your podcast platform or at fearandgreed.com.au. Thank you, Sean.
Thank you, Michael.
It's Thursday, the 23rd of February, 2023. Make sure you're following the podcast. Join us online on LinkedIn, Instagram, Twitter, and Facebook. All great ways of getting in touch, particularly if you've got any questions you want me to put to Sean on your behalf. I'm Michael Thompson, and that was Fear and Greed. Have a great day.